We're doing these quarterly economic updates with Dr. Arthur Laffer, and on each one of these sessions, we're also going to present three of our subject matter experts to give a high-level overview of what's happening in the area of tax, employee benefits, et cetera. So a little background on My Financial Coach. So about 3 years ago, a group of us, including Dr. Arthur Laffer, put together My Financial Coach. And our goal was to provide unbiased and unconflicted financial planning. What do we mean by that? I had a financial advisor for many, many years, and every time I worked on my financial plan with him, I wasn't sure if he was working on his retirement plan or my retirement plan because he was selling products and services. When we say unbiased and unconflicted, we don't sell any products or services. We don't provide any solutions. We basically work through all of the elements of comprehensive financial planning, from cash flow management to budgeting, all the way on the individual side, from someone starting off with student debts all the way through estate planning, business continuation, succession planning, exit strategies, et cetera. On the business side, many organizations like My Financial Coach because they're trying to attract, retain, and reward key employees in an organization. So many organizations start out by providing these key employees with extra benefits. They provide a 401k with a match. They might do a deferred compensation plan, maybe some equity compensation, phantom stock plans, medical insurance, et cetera. And most people don't really understand how these plans work. So they're certainly not appreciating what the company is providing and certainly not utilizing these to the maximum benefit. So the first thing we do is we aggregate all of those benefits on one secured site. Then we assign each of those key employees, and on the individual side, the same, their own certified financial planner, not a call center, but a certified financial planner who's a salaried employee, unbiased, unconflicted, to work through the entire plan. They do lots of modeling, and they do a lot of in-depth analysis of various concepts, et cetera. And we have a deep bench of subject matter experts. Three you're going to hear from today, but we have legal, accounting, tax. We have board certified estate planning lawyers. We have investment advisors, insurance experts. And many of these firms we sought out and brought aboard to My Financial Coach. So take a look at the website, take a look at the platform. I think you'll like the service. Many of our clients already have a financial advisor, so they love us to be a second opinion and an unbiased approach to their financial plans. So now we're going to start with our subject matter experts, and each is just going to give a little overview of a topic. So our first presenter today is Chris Rich. He's the Managing Director of Executive Benefit Solutions, a national firm that works in the non-qualified executive benefit space. He's got an extensive background. He's a former tax partner with Ernst & Young. And many of you that attended last, and I noticed here with the agenda today, are with publicly traded companies. And your organization has given you restricted stock units and other equity compensation. Today, Chris Rich is going to share with you some tax planning ideas as it relates to restricted stock units. Chris?
Thanks, Bill. As Bill said, our area of expertise is non-qualified deferred compensation. And as one of the most significant trends we see in the area of plan design today is the deferral of restricted stock units. Larger and larger share of executive compensation packages now, of course, consists of equity compensation, and among the equity compensation alternatives is restricted stock units has become one of the most important. So, Enpo, if you could bring up the slides, and I will walk through a very brief overview of the concept of deferring restricted stock units in a non-qualified deferred comp plan. So again, by way of introduction, if equity plan design has evolved over the last 15 years or so, And clearly, stock compensation is the largest component of executive compensation packages. And, the various forms of equity awards offered have evolved over the years as a result of an ever increasing emphasis on performance-based comp and some accounting and tax changes that had an impact on stock options in particular. The most common approach to plan design today is a portfolio approach, and RSUs are almost always included in the portfolio of equity options, both time-vested RSUs and performance-vested RSUs, or so-called PSUs. So next slide, please, Enpo. RSUs represent a significant, or have a number of advantages, and that's why they tend to dominate equity compensation packages today. From the company standpoint, RSUs provided a great deal of flexibility in terms of plan design, as well as simplified stock plan administration. So instead of having to issue shares up front, like with restricted stock shares, RSUs are not restricted typically until the end of the performance or vesting period. From the executive standpoint, what we're going to explore today very briefly is the opportunity for deferral of taxes upon vesting. Next slide, please. Just to be clear, that the general taxation of RSUs is they are subject to income taxes upon vesting. And so unlike stock options in the past that were so popular, there was some control. The executive had control over the timing of the tax event, but with RSUs, vesting typically triggers taxes. That is, unless you are able to coordinate the non-qualified deferred comp plan with your equity plan. And by using or properly designing a non-qualified deferred comp plan, you can permit the deferral of federal income taxes. You can even, in some cases, reduce or eliminate state income taxes, and you can allow far more flexible distribution options by deferring RSUs in the deferred comp plan. Next slide, please. However, one of the issues with deferring RSUs is that some executives are concerned about long-term exposure to a significant concentration of risk tied to company stock. So what some executives would really like to do is not only defer taxes on their RSUs, but then be able to diversify the holdings in the deferred comp account. By diversify, I mean being able to reallocate the portion of the deferred comp account denominated in RSUs, perhaps to other notional investment choices under the plan, such as an S&P 500 fund. Next slide, please. So what we've found in our experience is that a number of companies, or several, really many publicly traded companies, offer the opportunity for deferral of RSUs, but very, very few offer this opportunity for diversification. That is the ability, again, to reallocate to a more diverse portfolio within your deferred comp account. And the reason that many companies don't offer diversification is because of the conventional thinking that will trigger negative accounting issues. And we found that that's not necessarily the case. Next slide, please. So what we have been able to do with a number of our clients is to custom design a plan that allows for the deferral of federal income taxes, again, possible reduction or elimination of state taxes, as well as diversification of RSUs without triggering negative accounting issues. So we've had a good deal of success, and the permission within the plan for diversification could be based on a number of events or a certain time period, that is a holding period, or perhaps a change of control or retirement or certain age. So again, the addition of the option to defer and the addition of the opportunity for diversification of one's deferred comp account really significantly enhances the value of a company's total executive compensation and benefits package. So if you have an interest in this area, obviously we'd be very interested to speak with you. So next slide. And so there's contact information that's included with our presentation. So that's it for a quick overview of the concept of deferral and diversification of RSUs. And now back to Bill.
Yes, thank you, Chris. And on EBS's website, I think there's a number of white papers that are available that you can download on that subject, or you can reach out to us directly. Over the last few months, many of our business owners have been reaching out to us for exit strategy planning. You're building a closely held business. It's going to be a big asset in your estate, perhaps your retirement plan, and people are looking for different types of strategies. So one of the things we put into the My Financial Coach University is a tool where you can get a good valuation of your business. But that's only the start. What do you do with the business? How do you sell it? What are the different options? So our next presenter is Ed Renninger, who is the president of SES ESOP Strategies, and he's also the co-chairman of the ESOP Group and Employee Benefits and Executive Compensation Group at Stevens & Lee. And he's also a lawyer, obviously. And Stevens & Lee recently joined us as a subject matter expert in their estate planning group. So what Ed's going to cover today is the subject of ESOPs, probably a concept overlooked by many people when they're thinking about selling their business or doing that exit strategy. Ed?
Great, thanks, Bill. I appreciate the introduction. Empo, if you could go ahead and pull up the presentation. No reason to highlight my face on the screen here. Let's look at the source material. What I'll do here is I'll give you a very, very high-level introduction on really what an ESOP is, and then talk to you about some of the high-level tax benefits that you can get if you utilize an ESOP as an exit vehicle, and perhaps mention how tax reform could impact some of that stuff. And obviously, I'm not an expert as to what may or may not happen with respect to tax reform. Just wanted to throw out a couple hypotheticals. You can go ahead and move forward, Empo. This is just a little bit about us. No reason to spend any time on that, although I'm sure Bill and Empo would be happy to circulate to you a copy of this presentation if you want one after we're done. So you can read about us all night long if you'd like to do that. But we're part of a high-level part of a multidisciplinary professional services platform that has investment banking and legal services under one umbrella. And I run our ESOP consulting practice, SES ESOP Strategies. You can keep going, Empo. So what is an ESOP? An ESOP is a type of a retirement plan that was created by Congress back in the 70s. 1974 was part of ERISA. It stands for Employee Stock Ownership Plan. And the theory behind it is that Congress utilized the tax benefit provisions of the retirement part of the Internal Revenue Code to encourage business owners to explore selling their ESOPs selling their companies to an ESOP. And they did that through a variety of different tax benefits. But keep in mind, it is a type of a retirement plan. So what that means is your employees at the end of the day will have an account in their ESOP. In the world of retirement plans, ESOPs are classified as what we call defined contribution plans, meaning your employees have an account. But unlike a 401k plan or a profit sharing plan where their account will be invested in a broad basket of diversified assets, an ESOP by law is required to invest primarily in employer securities. So that's where an ESOP is very different. Rather than going out and diversifying assets, an ESOP is designed by Congress to invest just in employer securities. The theory being that by doing that, you're going to benefit your employees in the long run by being able to share in the growth of the company, but also create some potentially material tax benefits for the company as well as the selling shareholder. You can move forward, Empo. So I'm just going to highlight some of the tax benefits briefly, and then I'll give you some numerical examples of those. And this is, by the way, just by way of background, this is exceptionally high level. There's a lot of complexity and nuance as it relates to ESOPs. And if you had specific questions, more than happy to answer any that you may have at a future point in time if you wanted to ask those. But one is it gives the selling shareholder the ability to take advantage of a deferral on the payment of capital gains tax when they sell their business. It takes advantage of Section 1042 of the Internal Revenue Code. That's why we call it a 1042 transaction. And effectively, if you follow the rules, and there's a lot of rules, but if you follow the rules, what that effectively lets the owner do is to not pay tax on the sale of stock to the ESOP. And if they invest in the right property after the transaction is done, under the current tax law, that property gets a step up in basis at death, and therefore not only have we deferred payment of the capital gain tax, we have eliminated under current tax law the payment of capital gain tax if a selling shareholder takes advantage of Code Section 1042. Again, a lot of rules and regulations to get there, a lot of nuance to make sure you're doing it right. But as you can imagine, someone who has a material amount of wealth built up in their business with what is probably a fairly low basis over the years, this could be a very, very attractive tool, especially if capital gains rates go up in the future under potential tax reform. So that's one thing to keep in the back of your mind, very high level, 1042. And I'll give you a numerical example of what that can mean a little later. What else does an ESOP do? An ESOP actually lets the company pay back the debt from financing the purchase or sale of stock to the ESOP, effectively with pre-tax dollars. So typically, if you go to a bank and borrow, say, $10 million, for example, and the company wants to pay back that $10 million, they can get a deduction for the interest they pay on the 10 million, but the 10 million they're paying, the principal they borrowed, they're repaying that with after-tax dollars. With an ESOP, if you structure it properly, you effectively get to deduct the cost of that borrowing, that $10 million in my hypothetical. You can effectively pay for that with pre-tax dollars. So it makes the company more cash flow positive, more tax efficient by utilizing that mechanism. And Bo, you can go ahead and move on enough on that page. So what I want to do is just highlight a couple numerical examples very quickly and then wrap it up here. And this is an example of a 1042 transaction. And what I highlighted for you here very briefly is under current tax law, current federal capital gains rates. What we highlighted here for you is a comparison of a $16 million sale to an ESOP versus an $18.5 million sale to a third party. In this example, we assume that the owners had a basis of $4 million in the transaction, and in the non-ESOP sale, they would have had to pay capital gain on that, which would have been capital gain on $14.5 million, which effectively puts $15 million in their pocket at the end of the day. Whereas if they can take advantage of 1042, even though they would have sold for less money to the ESOP, they can put more after-tax proceeds in their pocket, which is really what matters, right? It's what cash do you really walk away from at the end of the day by taking advantage of the 1042 regime. So Empa, go ahead and flip it forward. Now, using the same example, what we modeled, go back one page, Empa. What we modeled here using the same example is we said, well, what happens if capital gains go up from, the 20% effective rate for most high wage earners to 39.6 or 40% under tax reform? And I'll let Dr. Laffer talk about whether that's even a possibility, but it's at least been proposed. And in that example, what happens is your ESOP gets to start looking even more attractive relative to the status quo. So you can move forward, Empa. It puts a lot more money in pocket at the end of the day. And this highlights, using that same $60 million example for you, the benefit of being able to deduct the repayment of that debt using pre-tax dollars. So in this example, if you borrow $16 million under current tax law, you're basically saving about $3 million relative to borrowing $16 million that you have to pay back with after-tax dollars. Again, just trying to show you kind of the benefits under the current tax law. And if you go to the next slide, you can see our hypothetical example of bumping that up to a 36% effective federal and state rate. Again, a larger benefit, you're effectively saving just under $4 million in that example. So if tax rates go up in almost any way you look at it, the ESOP starts to look even more attractive relative to other third-party transactions. And I think, Epo, I might have one more material slide in here that I wanted to quickly touch on before we wrap it up. Oh yeah, the last real big benefit, and this blows people's minds when they first learned about it if they don't know about it already, but in an S corporation, the company doesn't pay tax. The shareholder pays the tax. It's a pass-through entity. The magic of an ESOP owning an S corporation is that the ESOP trust is a tax-exempt retirement trust. So if you have an ESOP that owns 100% of an S corporation, you don't have to make tax distributions to the shareholder to enable them to pay their taxes. So if you assume, say, for example, a hypothetical 32% effective federal and state blended tax rate, and you're generating $10 million of taxable income every year, that company is saving $3.2 million of cash flow that it doesn't need to pay out to its shareholder just to pay taxes. And if you flip to the next page, you'll see a hypothetical assumption of that going up a couple percent. And that's basically it, right? I mean, the reality is ESOPs are exceptionally tax efficient. If tax rates go up, it tends to give ESOPs a little bit of an advantage as an exit vehicle. This presentation is available from Bill and Empo if you wanted to get it to look at it a little more closely in the future. And obviously, I can always answer any questions you have. That's basically it.
All right. Thank you, Ed. Yes, all these presentations will be part of the recording. They'll be on the site. You can download them. The thing that I like about the resources that we've brought to the table with SES is that they not only look at the ESOP, but they have other strategies through the law firm of Stevens and Lee to look at mergers, acquisitions, selling the business, and ESOP is a great strategy. Our CFPs really enjoy working with the subject matter experts because they think out of the box, but they come up with concepts that are well documented and proven. Our final subject matter expert today, staying with the theme of saving taxes and reduce taxes, is Michael Engelhardt. He's the president of Human Capital Risk Management Advisors. He has over 25 years of experience working with businesses and high net worth individuals on the subject of reducing their tax liabilities and accumulating wealth on a pre-tax basis. Michael?
Bill, Empo, thank you very much. Really appreciate you letting me participate today, and hello to everybody. I'm going to share with you a concept called land conservation through land conservation easements to potentially reduce your adjusted gross income by up to 50%. So Empo, if you can launch the slides and go to 2 more slides down. Sure. So land conservation easements have been around for 40 years. 40 years ago, it was a bipartisan bill that was passed, and it had the support because Congress wanted to protect wildlife, agriculture, and farming. And in order to do that, they needed to offer a benefit to people who would want to contribute their land or grant an easement to a land trust permanently into perpetuity as to not develop the property. So 40 years ago, Congress and the IRS said you can reduce your AGI by up to 30% through a land conservation easement. And the way we get at what the value is a highest and best use study is conducted on the property that you own or you acquire. And based upon that highest and best use, if you determine that you want to grant an easement into perpetuity, you will get the stepped up value of that property as a deduction, a line 13 non-cash charitable deduction. So today, land conservation is even more important than it was 40 years ago, particularly as the Biden administration at least has an interest in a third of the US being green. We fall, if you take Alaska out of the equation, we fall woefully behind on most countries in terms of conserving land. So today, as of 2016, land conservation easements became part of the permanent tax code. And the tax code today allows you to offset up to 50% of your adjusted gross income through a land conservation easement. What does that mean? Well, if you live in New York State and you earned $2 million of AGI and you invested in a land transaction that was voted on to be conserved, your deduction would be $1 million. So if you invested $200,000 into a land transaction and it was voted on by a simple majority to be conserved, you would receive a $1 million line 13 non-cash charitable deduction because you would be foregoing all of that future value. And that would translate into a $374,000 federal income tax refund and a $44,000 New York State refund, which combined would be $414,000. Again, if it was voted on to be conserved, you would have invested $200,000 and you would be receiving $414,000 back in refunds. So there's 3 ways that land conservation easements have the opportunity to be accomplished. One is with people who own their own property, where they want to conserve the property into perpetuity and they're looking to garner a deduction. 2 is through non-syndicated transactions, and 3 is through syndicated transactions, which aggregate investors into a limited liability company with a business plan to develop the property. In many cases, it's a solar development. And then once all the money is raised, the investors will have the option to vote on whether they choose to conserve the property, hold the property, or develop it as a solar project. Again, a simple majority wins the vote. So land conservation is a very important tool to reduce the carbon footprint, to protect the watershed, to protect agriculture, farming, and conservation in general. There's still bipartisan support in the Senate and in the House for land conservation. We think it's going to expand. And we think that the incentive is aligned with causing people to want to conserve the property as opposed to developing it. So if you have any particular questions, feel free to reach out to us. We're very busy now, given all the potential changes happening in Congress with taxes, and people are a little bit concerned about what may happen. So happy to have private conversations and discuss more in detail what we did. Bill and Bill, thanks so much.
Okay, thank you, Michael. So we've just highlighted 3 of our subject matter experts, and you can go back to last quarter's presentations and see 3 that presented last month. You can see the deep and why our CFPs are so excited about working with subject matter experts who can think out of the box and bring various concepts to the table. Do we have Dr. Laffer in the house? Great. So it gives me a great pleasure to introduce Dr. Arthur Laffer, my friend and fellow shareholder and director here at My Financial Coach. I wish I would have listened, speaking of taxes, to Dr. Laffer back in 2005 when he fled the great state of California for Tennessee. I held on, stayed on until just 6 months ago, but it probably is worth a couple $1 million of benefit if I would have pulled the trigger back then. But I figured, what does this economist know about the economy, right? So gives me a great pleasure. Many of you know his background, obviously. He was an economic advisor to President Reagan. He created the great Laffer curve of economics, which is a great YouTube video if you want to see the enactment of the writing on the napkin and so forth. But I want to talk about things that you might not know about Dr. Laffer. He was the first to hold the title of chief economist at the OMB under George Shultz. He was actually a professor at the University of Chicago under George Shultz and also taught at the University of Southern California. In 1986, he was a candidate for Republican nomination for senator in California. He was the advisor to many states and foreign countries on government and tax laws, including Margaret Thatcher, working with Margaret Thatcher. And he worked for the Californians on Prop 13 to help reduce taxes. So you can read, again, a lot. If you just Google his name, there's plenty of data on Dr. Laffer, and this overview on giving what his awards are and so forth would probably take the balance of this presentation. But on May 19th in 2019, he received the Presidential Medal of Freedom for his economics from Donald Trump. It gives me a great pleasure to introduce my friend, Dr. Arthur Laffer.
Thank you very much, Bill. My goodness gracious, that was really nice. Let me just say, I'm very glad you didn't mention the consequences of the Senate race in California. Just for the record, just so everyone knows, I got less votes than the adult members of my family. So that sort of says it all, doesn't it? I should stay out of politics. No, I just love the presentations, the 3 presentations before, and I apologize for being so anticlimactic because Chris's presentation on RSUs and Ed's on ESOPs, and then my favorite on land conservation easements. I'm going to get back to Michael on that one. I've got a lot of land up in Kentucky, and I don't know how they evaluate it for the easement purpose for taxes, but I've got about 2,500 acres, Michael, up in Kentucky, and I'd love to chat with you about how we can do something to ease my income tax burden there. Let me, if I can, just go into the current situation today in the U.S., and I want to go through what's happening. I want to go through the tax bill. I want to go through voting rights. I want to go through politics, and I want to mention and talk about inflation very briefly. And I'm not going to spend a lot of time on any of these. But first place, is that okay, Bill?
Yeah.
Okay,
Yeah.
great. And what I'd like to do is that the tax bill under consideration, and I got briefed this morning on where it stands. The tax bill probably will not raise the corporate tax rate from 21 to 28%, but the estimates now are that it'll be damped down a little bit. They probably can get some sort of majority supporting something like a 25% tax rate. If they had gone to 28% tax on the corporation, that would be the highest tax rate in the OECD of the developed world. So that would really put us back right into the soup we were in before Trump came into office. There are some other things on the tax bill they're trying to get through. They got on the G7, they got the Treasury secretaries on the G7 all agreeing on a global minimum tax. Now, this is every country making sure they don't become tax competitors. So there will be a global minimum tax, and it was at 15% or even higher. I don't think that's going to make it through as well. Donald Trump is also proposing a U.S. minimum tax on profits retained abroad. Donald Trump put it in at 10.5%, which was a huge reflow of tax revenues from profits held abroad. Biden is proposing raising that to 21%. Again, the thought is that it's probably not going to make it, but you can't all be sure. The personal income tax rate they're proposing would go up to 39.6, sort of undo the Donald Trump number and get it up from 37 to 39.6. The pass-throughs, there were some discussion of that, but no one really knows whether the pass-throughs can make it or not. This is sort of the income and corporate and personal there. There is some consensus that they're going to get something done on the state level, They don't think they're going to get rid of the step-up basis on the estates for unrealized capital gains, but they do think they're going to shrink the amounts tax-free, and they do think they're going to probably raise rates a little bit. So that's where we are on the tax bill. Let me just put the tax bill in a 30,000 foot, if I can. What Biden is trying to do, he's trying to undo the Trump tax cuts. I mean, that's exactly what he's trying to do. In 2017, Trump dropped the highest marginal income tax rate on corporate profits from 35% to 21%. That's what he did. He also dropped the personal income tax rate from 39.6 to 37. He put some pass-throughs that reduced it another 20% beyond that. So that was pretty good. They got rid of the individual mandate, not got rid of the mandate, got rid of the fine for the individual mandate, which meant that there was no expenditure on that. The SALT tax deductions. He also got a $10,000 limit on state and local tax deductions. There were others. There were some 100% expensing of capital purchases over the next 5 years. There were some other capital ones involved. But bottom line is Biden is trying to reverse that plan almost 100%. Now, if you look at the results from that plan, and I'm going to go through this a little bit with you. I looked at GDP of the US by quarter for the 2 years prior to the tax bill being passed in the fourth quarter of 2017. If you look at those quarterly movements of US GDP relative to the Eurozone, they moved right together. The two of them moved right together. No deviation by quarter. I mean, literally moving right in the pattern together. Once the tax bill took effect, Eurozone GDP fell fairly sharply. The US GDP did not fall sharply. And in fact, after the 2 years following the tax cut, US GDP was 2.5% higher than it would have been had it grown at the Eurozone growth rate. I'm going to attribute that to the tax bill. I think it's true. 2.5% of 20 trillion gives you about $500 billion, which isn't chopped liver in our terms. It's a very significant improvement over that. And my view is just really wonderful for the economy. If you look at it in employment terms, poverty in the U.S. dropped to a record low. The measure of poverty for the U.S. dropped to a record low. Now it was dropping under Obama. It was dropping nicely under Obama, but it continued under Trump and fell to a record low after the tax bill in 2019. If you look at the unemployment rates for minorities, for population at large, all those unemployment rates dropped dramatically. Not only the drop, but for minorities, Hispanics, blacks, and undereducated, people without high school diplomas. Those unemployment rates dropped to record lows. I also attribute that to the tax bill to be very serious. Now, the one I want to talk to you about most of all here is that if you look at tax revenues, now this is federal tax revenues, corporate plus all other federal tax revenues. And if you look at federal, state, and local tax revenues, which adds in state and local tax revenues, if you look at it 4 years before the tax cut to 2 years before the tax cut, 2 years before the tax cut, up to the tax cut, and then the 2 years following that tax cut, if you look at federal tax revenues, it is very clear that corporate tax revenues dropped quite sharply after the tax cut, but total federal revenues increased after the tax cut. In other words, the loss in corporate was more than made up for by all of their federal taxes, such that tax revenues were higher after the tax cut, and not only were higher, but they grew by more than they had in the prior 2 years before the tax cut, or in the prior 4 years to 2 years ago. They were higher than and growing faster than that. These tax cuts literally paid for themselves fully and completely. Any reversal of those tax cuts, if Biden is successful, which he probably will be quite successful, will in fact reverse the results in this person's view of the world. I think it will lead to a slowdown in the economy. It'll lead to larger deficits, not smaller deficits, and it'll lead to less prosperity. That's my view of the world on the tax bill. I think if you see the voting rights on the voting rights bill, this is the number one priority of the Biden administration. It's the number one priority of Schumer and of Pelosi. Right now, it looked like for a moment that Joe Manchin was going to block that. Now it looks like Joe Manchin is not going to block that. And I don't know how it comes out, but they have to get rid of the filibuster and get Joe Manchin and Sinema involved in that. They've made a lot of concessions, the Democrats have, in the voting rights bill, but it looks like, in my view, something is going to come through and be successful there. On the politics of today, this is just as of today, it looks very likely that the Republicans will pick up control of the House. And in fact, there are some people that say the Republicans are going to pick up control of the House by a very large amount, a flip of up to 60 seats. And that would be an enormous increase in Republican control. There is a small chance, but not insignificant, let's say 30–40% chance that the Republicans will flip control of the Senate as well. Now, because the races are so much biased against the Republicans, that the Senate races in 2022 have many more Republicans up for re-election than Democrats, which means that would be a miracle if the Republicans were able to pick up control of the Senate. The governors, it looks like the governor's races, Republicans are about to pick up some major ones as well in the next period coming through. Now, the last thing I want to talk to you about is inflation. Every business I know is talking about the increase in costs that are coming through. I mean, the raw material prices, lumber prices especially, but all these raw materials prices, oil, all of these material prices are rising. If you look at labor wages are rising. All of those indicate a much increased rate of inflation. But frankly, from a standpoint of macroeconomics, while the CPI rose by a lot year over year, the producers price index, the wholesale price index, the commodities price index, all have risen a great deal up until today. There is no sign in the macroeconomy of inflation being embedded in the market. Gold prices, which are a classic hedge against inflation, gold prices have not risen very much at all, if any. There's just no sign of an inflation there. You know, gold is the first refuge of the cautious. When inflation comes, gold prices rise like they did in the 1970s. There is no increase in gold prices to indicate any type of inflation coming. If you look at bond yields, the 10-year bond yields, there's no indication again of any inflation being implicit in the 10-year bond yields. And in fact, if anything, very recently, the dollar has been very strong and those bond yields have fallen. Again, from the standpoint of macroeconomics, and this is where I come in, is I don't see personally any increase in the rate of inflation today as measured in the marketplace. Now, I know all the businesses are telling us about how those prices are, but if I were to gauge it from the markets, what they are seeing is a rise in the price level to then coming back down, and that inflation is not embedded in the economy. That's where I'm coming out on all of this stuff. You're seeing the US economy catching up to where it was, but we have a long way to go to catch back up to where we would have been before, had the trend continued through the COVID period, had we not had COVID-19. I mean, we are still well below our potential, but with all of this stimulus spending, my best guess is that we have taken the long-term growth rate of the US and reduced it quite substantially. And Bill, that's my story, and I'm going to stick to it. But I really got to congratulate you on Chris's and Ed's and Michael's presentations. They were really first class.
Thank you, Dr. Laffer. Are there questions, Empo?
Yeah, so we had a few people with some questions, and we do encourage everyone to use the chat feature. If you have any questions, you can either put it on the everyone screen, or you can directly message me if you want to remain anonymous. One thing that we wanted to ask, there were a few charts that you had referenced. Dr. Laffer, will that be available in your book, or will you be able to maybe provide us with some of the things that you were referencing today on the call?
Well, let me just tell you, I can provide you with a pamphlet on the Trump tax cuts and what happened to the revenues, what happened to the employment. I've got that very clearly listed precisely. You know, the proposals, Empo, that you see being made in the G7 and in Congress right now, they're very fluid. I mean, the views I have are from the insiders I deal with, and they are not Republicans or Democrats per se. This is just people who count votes and look at it. And that I'm just trying to give all of the group here a flavor of what they think is going to happen. I am no expert on reading the tea leaves in Congress, but it doesn't look like Biden's election is going to be able to push through a lot of that stuff, but he's going to be successful in some of it. And he's already been successful in a lot of the big spending stuff. But the infrastructure, $6 trillion, people don't think that has much of a chance. He's going to use reconciliation. They would much rather have a bipartisan infrastructure bill. If they do a bipartisan infrastructure bill, there has been talk about then following it with a companion bill done just by Democrats using reconciliation. I don't think that's going to happen. I mean, there's no way the Republicans are going to agree to the bulk of it and then have them try to get another thing through. So that's where it is now. Biden is running well behind schedule on getting these bills through. He's got a lot of push to do, but just remember that the real one they're pushing is HR 1 or Senate Bill 1, which is the voting rights bill. And they're going to have to modify that bill a great deal. Absentee voting is going to be limited. They are going to have voter ID, photo ID. If they're going to get any of that through, they're going to need all of those things, which are photo ID is very popular. 80% of the people want photo ID for their votes. The other ones make sure that they don't have this long pre-voting period, and no vote should be counted after the election is over. In other words, if you have send in a ballot and it comes a week late, there's no way they should go back and reform. Those are things that I've heard will be in the bill if it happens. And it's still a very biased bill against Republicans, but it can be modified. But don't count on Joe Manchin or Sinema to save you. Joe Manchin and Sinema probably won't save you.
All right. So this one is, I understand that you don't read the tea leaves, but we did have one question come in. What is your opinion on cryptocurrencies? Not necessarily the blockchain technologies underlying them, but I guess more of that speculative frenzy, and or it could just be a early investment into an asset class.
Yeah, well, I did a podcast about 4 years ago with one of my students. Some of you may know her, Kathy Wood. Kathy Wood of ARC. I'm a part owner and on the board of ARC and board of advisors of ARC. She was my student at the University of Southern California. She's the most wonderful, brilliant, hardworking person who doesn't do anything on beliefs. She does it all on research. She's just amazingly wonderful. When I've looked at cryptocurrencies and especially Bitcoin, I think of Bitcoin as being a way around the US dollar or around other currencies, number one, as it's an alternative payments mechanism, but much less so an alternative payments mechanism than it is an alternative source of wealth value. It's sort of much more, in my mind, a competitor for gold than it is for the US dollar or the Chinese yuan or whatever. So I look at cryptocurrencies and I'm really quite I quite delight in them, although I'm not an owner of them in any way, shape, or form. But I think they have a role. But I think you can really see how powerful and important they are by looking at Mnuchin's comments on cryptocurrencies. He's just bashing them nonstop. You look at Xi's comments on cryptocurrencies in China, and they're bashing them nonstop. They're prohibiting mining of Bitcoin. So, you know, there is a full-scale war now going on from governments against cryptocurrencies, which tells me they can't be all bad.
All right. So when it comes to inflation, I know that you touched on that towards the end. There's a lot of talk about temporary versus long term. And I mean, for example, looking at lumber and some of the core basket of items, not just the readings. Do you feel that inflation may be transitory, or do you feel that they will be long term?
Well, what I try to say is in macroeconomics, where I am, Empo, and that's just remember, these are the tools I use. There are a lot of other tools that other people use. I use the gold price. I use the bond yield, the 10-year bond yield. I use the TIPS yield as the real yield there, and I use the dollar and the foreign exchanges. And from those instruments that I'm talking to you here, there is no sign whatsoever of long-term inflation. There just plain isn't. Now, there's one thing in the macro world that is true, is that given that reserve requirements no longer are binding in any way, shape, or form, excess reserves are so huge that if inflation did start catching on, there is nothing to constrain it. Historically, it has always been that you can control the expansion of bank liabilities because you have reserve requirements and they hit that requirement. That's not going to happen. I think excess reserves are 10 times required reserves. So there is no ceiling on how high it can go. Now, that's a worrisome thing, but not so much so. Now, everyone who really is dealing in commodities and products that all they can see is rising prices. They see wages rising, especially at the low end. And once a wage is in there, I don't see it coming back down. These people, to a person, see high and rising inflation coming in. Yes, they may see it dip back down from some of these temporary highs, but they do see inflation. I'm not of that ilk. That's not the set of tools I use. But if you look at Kevin Hassett, who used to be head of the Council of Economic Advisors under Trump. You look at Larry Lindsay, some of these other people who are very credible economists. They all see high and rising inflation coming back to the US. I frankly just don't see it in my numbers. I hope that answers the question, Empo.
I believe so. So estate tax thresholds are set in 2026 to drop from the 11.7 back down to the 5.5. With your insight on Capitol Hill and just the discussions that are going on, do you potentially see it going even lower than the 5.5 in the near future?
What is this now?
So currently the estate tax threshold, it's at 11.7.
Yeah,
it will
I got that.
Oh, okay.
I didn't hear you. I do not see at present any way of not letting that drop back down. When it hits that period, it will drop back down unless there is a Republican majority in the House, the Senate, and the presidency. And if that happens, the Republicans, I'm sure, will keep it high, maybe even expand it. But the Democrats would never, ever, ever stop a reduction in the threshold on death taxes. That just is not in their nature. They would like, a lot of them want to see wealth taxes imposed. Many of the Senate members on the Democratic side would love to see get rid of the step-up basis. You saw the ProPublica piece on what tax returns are for the very top. I think they had Bezos, and I think it had Buffett, I think they had Soros, I think it Bill Gates. They had a bunch of others in that that they released their tax returns, and what you saw was that these people don't pay income taxes. They really don't. And so there's a lot of pressure on the sort of the wealth tax side coming through. It's not going to make it this round. Now, if the politics turns against the Democrats in 22, which from what I hear, and I'm not a political expert either, but from what I hear, it's going to turn against them in the House for sure. And there's a reasonable chance, not a 50-50, but a reasonable chance, let's say 30%, that we can flip the Senate the other way for the Republicans. If that happens, none of this stuff will go through once the next election people take seats.
Dr. Laffer, we want to be extremely respectful of your time. How much time do you still have left with us so that we can maybe choose?
No more than 4 hours.
Oh, okay. Excellent. Well, how about this? Do you have time for at least one or two more questions?
Sure. And I just want everyone to realize that I think I'm fairly a large shareholder, Bill.
You are.
My financial coach. And I just want to say to everyone here just how much I respect Bill McDonald. I've worked with him now for billions of years. Empo, I've worked with you several years. And, you know, I just think my financial coach is just fantastic. And I enjoy watching these sessions more than I do anything. I wish I could absorb all the information and use it all myself, but it's just great.
All right. Well, so one of the questions that we have is when you're thinking of CPI inflation, it's relative to what has been going on recently. And because there was a massive drop in prices last year due to COVID, for example, the price of flights dropped. I believe at one point oil went negative. And now that the economy is starting to pick up steam, do you feel that some of the inflation going up higher is relative to the fact that we had a cratering of prices last year, and so that may have thrown off some of the measurements?
I do not think that that is the primary source of the rise in prices. Now, however, you're very, very correct. Whenever you do it year over year or quarter over quarter, but I think if you look at the year over year going back, so it gets this out of there, or if you look at prices relative to 2019, so you get a 2-year period, I think you'll still find very substantial price increases in there on these products. But there was a huge drop in prices, especially around March of 2020 when the pandemic hit. And I don't know if any of you noticed there was a little stock price dip at that time. Just joking. You know, you look at all of this put together, and I just don't see it in my numbers, Empo. And I've got to go by the numbers. And you know, I'm on the boards of a number of companies, and every one of those companies tells me their raw material prices, their labor prices, all these are rising. And it's very true. I mean, they're giving bonuses out to these people. Their on-time deliveries are very not doing well. They're low on time because they can't get the employees. The wages are built in and all that. You know, all of that's very true, but the macro numbers just don't show it. Gold doesn't show it. The bond yields don't show it. And the dollar in the foreign exchanges doesn't show it either. So that's my story. And I'm going to stick to that one, but I'm wrong a lot, but I don't ever try to be.
Okay, last question. And there has been some talk about long-term capital gains tax. You mentioned it earlier. Based on your insight, where do you think we end up on the long-term capital gains question?
Yeah, Biden is very focused on trying to raise that long-term capital gains tax rate up to 40-something% to really put it right in line with personal income tax. If any of you live in California, or I think in New York as well, capital gains on a state level is taxed as ordinary income. And I think that's the way Biden would like it to be in the US. From what I understand is there are a number of Democrats who are really resistant to this, as well as every Republican. So there's going to have to be some trade-offs here. Now, Biden has basically given complete credibility to the left side of the party, the liberal side, the Bernie Sanders wing, the Elizabeth Warren, and he has put everything he could possibly think of that's to the left in all of his legislation. And to the extent that it fails, he can clearly say to them, he's tried, he's done his best for that. Now let's negotiate and get some deals done. which means that the capital gains tax will not rise to 43%. But if it stayed where it is now, I'd be really surprised. The one capital gains tax rate that is very interesting from my standpoint is on owner-occupied homes. Because if you'll remember, under Bill Clinton, we effectively got rid of the capital gains tax on owner-occupied homes, which is about half the capital stock. Now, admittedly, those prices have risen and the constraints not there, but there is still a very big advantage in buying and selling owner-occupied homes. You get a big exemption on the first part of your capital gains. So that's still there. I have not heard anyone talk about reversing that, not one person. On the other capital gains, the non-home equity on the tax rates there's a lot of pushback against Biden's proposal.
All right. Well, I believe that we have taken a good amount of your time, Dr. Laffer. It's always good to have the opportunity to ask you questions.
Just make money.
Okay, absolutely.
Bill, don't let that Bill McDonald push you around, Empo.
I'll keep him honest.
Keep his golf games down so he doesn't have the fee and he can spend some time in the office actually working. You know what I mean?
Absolutely.
You're on it, Empo. I'm okay. Sorry, Bill.
Thank you, Dr. Laffer.
Thank you. Thank you, guys.
Thank you for everything you do for us.
That's wonderful. I love the group and love the company, Bill.
All right.